investors, if you want to get rich with stocks that go 1,000% or more, I'm talking about cheap penny stocks, even dog stocks. That's right. Today I'm going to be talking about the stocks that are dogs with fleas, and how even those dogs with fleas can increase 1,000% or more. So please pay attention. Now, in case you don't know, my name is Jack Marks, and I literally wrote the book on 10-bagger stocks. It's called 10-bagger Blueprint. You can get this on Amazon. This is my proven system for finding stocks that go up 1,000% or more. Now, the 10-bagger window, in case you don't know, and I'm going to explain to you exactly how it applies to even dog stocks that are dogs with fleas, that everybody has given up hope on. But my theory that I've developed is that all stocks, any stock that has big gains, if you notice, all those gains usually happen. The ones that go up 1,000% or more, again, whether it's Apple, Google, whatever it is, Amazon, all those big gains usually happen in a small period of time. The rest of the time, the stocks are usually just trending sideways or whatever. It's kind of like the Pareto principle, that 5% rule or the 1% rule. However you want to call it, but the idea is very similar. So, why does it really work? Well, it's because certain things line up for these companies. For example, the theme that they're in becomes hot. They hit a couple of hot catalysts, news stories. There's some other new events that come in, and where investors start to reevaluate the stock. Maybe there's some stock promotion. That always helps, right? But those are the things that can help a stock increase 1,000% or more in a period of anywhere from 4 months to 6 months. We've seen, again, crazy moves. We've seen a 50-bagger, 5,000% in just 4 months. That's right, a nickel stock that went to 250. Now, that was a dog stock, okay? That's what we're going to be talking about today, a dog with fleas. That company was Empower Clinics. Now, there's an old expression, every dog has his day, right? I'm not sure exactly what that means, but I guess the idea is that even the most unredeemable companies, the ones that are, complete garbage management, garbage business model, whatever it is, they all have a moment where they can have a pop. Now, again, if it's a really garbage company, it may not have a pop of 1,000%. It may only go up a couple hundred, maybe 300, 500%. But again, look, there's an old expression, at a price, anything will sell, right? It's just a question of price, right? So when a stock gets cheap enough, when it gets really cheap enough, there's a greed factor, right? You have, greed comes in and people say, wow, this thing is trading at a market cap of only $2 million or whatever. And, the opportunity is X. So, they see that asymmetric bet. Again, it's something I talk about in the book, that asymmetric setup where, you could have a 20-to-1 payout. The risk is so low. But when those things become so cheap, they need to get just a couple things right. They need to get a couple things right, and if those things happen, the market gets completely surprised. Those stocks can really move. So an example is Empower Clinics. How did that dog, and that was a dog, how did this thing become a 50-bagger? Sorry, 5,000% increase. Well, a couple things happened. Number one is it shouldn't have gone up 5,000%. It should have only become a 10-bagger, because that's what the comps were in that space that they were in, which was the medical clinic space. During that market, that's what they could have realistically been able to sustain, right? But it went up 50x because it was a hot market. So there's a couple things happened. One is there was a hot market which multiplied everything by 3 to 4x. Okay, so if it would have been a 10-bagger, became a 50-bagger. The other thing is, again, it was the right theme. The CEO was likable. Okay, he actually good personality. It was a weird personality. Like, people really liked this guy. I don't think he was very competent. Apparently not, because the stock went from a nickel to 250 and to zero, or a penny, or whatever it is right now. So a real round trip. Now, when we got involved, it was a nickel, and everybody gave up hope on it because this company never delivered, never performed. It was considered a dog with fleas. But we saw this. Our thesis for it was. You had they were in the right space at the right time. Now, they didn't really have a business model to speak of, But there was well, I should say they didn't have a real business, not much of a business, but they had a business model. They had the CEO had some ideas. They had a little bit of cash, and anyway, somehow or other, there was enough there for a store to develop, right? And we started getting the CEO involved with investors. Obviously, they got into the Wall Street Report platform, so he was exposed to millions of investors. And the story caught on. Now, again, that was a dog stock, but the other thing is this. What was interesting about the stock was, in that particular case, they had a big legacy shareholder base, or they had thousands of shareholders who owned the stock from years back. They were bag holders. They were taking deep losses. I think they owned it on average maybe 10 cents or whatever, and it was trading at nickel. No, much higher actually. But anyway, so these guys were bag holders, and the reason these guys got re-energized, started buying the stock, was that the real reason was the company got onto the Wall Street Report platform, and we were coming off a couple of big winners. We had a couple of 10-bagger stocks at that time right behind us. So everybody said, "Wow, this could be Wall Street Reporter's next 10-bagger winner." And by the way, that's how that helps a lot, right? So success begets success. Next thing you know, people they start paying a little attention. The stock doubled after a little while, and sure enough, the company had developed some news. I think they were trying to do some acquisitions. I forget what it was, but they had some positive news in a short period of time. Right? That's a big thing. It all happened in a short period of time, and that type of activity in a short period of time really surprised the market. People were not expecting that at all. And the stock went bananas. It went up 5,000%. Of course, as soon as it went to 250. The CEO went MIA. I don't know. He freaked out. He couldn't handle the success, and instead of doing what a 100x CEO does, which is raise capital, which is do acquisitions, and he was offered, by the way, $50 million cash in a private placement. He never returned calls, I guess. But anyway, he blew the opportunity, and that stock went from 250. Slowly it started descending, and of course by that time our contract was up, so we moved on, and everybody thought that this thing is going to go to the moon. But the reality is this: when Wall Street Reporter was no longer involved with the company, generally speaking, there's two reasons, right? There's the reason number one is we don't think there's any upside opportunity left, or reason number two is the company does not want to renew our contract because they think they know better about marketing, investor marketing, things like that, or creating shareholder value, and they don't. It's the reality. I can say this with 100% confidence. After 25 years, creating $1 trillion in wealth for investors, hundreds, I don't know how many hundreds of doubles, triples, multi-baggers we've had, 10 baggers. Couple hundred baggers. Look, there's no CEO out there that's created as much shareholder value repeatedly over and over and over again. A couple of these guys may have gotten lucky one or two times, but what we do is not luck, and it's based on a format. It's based on a system. It's based on a framework. So, you have to realize this. I have rarely been wrong about stocks in terms of if I think a stock is overpriced, I think it's something that's going to go down. If they're doing the wrong thing, it usually does go down, almost 99% of the time. Now, I have been wrong about stocks going up. Sometimes I think something should go up, and for whatever reason, it doesn't work out. But in terms of stocks going down, I'm actually pretty like 99%. Maybe I should become a professional short seller, because it really comes down to this, my friends, is that there are some things that you got to do as a CEO of a company. One of them is you got to know how to promote the stock. You got to know how to take advantage of market opportunities when they present themselves to you, and you need to have some balls. You need to have big balls. You gotta know how to deal with shareholders, had to deal with regulators, especially the Canadian regulators, who are, real scumbags. I mean, they're basically Marxist communists, and they don't know capital markets, and they like to meddle. They like to meddle with companies because they're haters. Basically, you got to realize these Canadians. The Canadian regulators like the TSX, the CSC, right, not so much the CSC, but the TSX, the BCSC, those are the Canadian regulators for the Canadian companies. By the way, the SEC is not like that at all. The SEC is, they have clear rules. All they care about is, regulating fraud or whatever. The Canadians like to really get involved. They like to have input. They like to stick their dirty noses into the company's business and meddle into how they actually operate. So, the CEOs have to actually, ask these guys for permission to do a lot of things. It's kind of a joke. I think I really feel bad for these companies. So, the CEOs who have some balls, they know how to push back against these Canadian regulators, and the ones who don't, they get pushed around. So you got to make sure that the CEO who's running the company has got balls. It's better, especially if they're Americans, quite frankly. For example, Nexttech, even though it was a CSE listed company, the CEO was American, so that stock did well when they went on a program, became a 12-bagger. Those things are important. Anyway, let me know what you guys think. Leave your comments below.